with us Mr. Nilesh Shah, the MD and CEO at Axis Capital, managing investments, banking, broking, and NBFC business of Axis Bank. He also has worked with ICICI Prudential Mutual Fund, Franklin Templeton Mutual Fund, and ICICI Security, covering debt, equity, currency, and real estate markets over the last 2 decades. I proudly say CA Nilesh is a gold medalist chartered accountant and cost accountant. He is also a topper of GFM 25 course at JP Morgan. Clap right now. So friends, whether this gold medalists see India as a gold mine or otherwise, we have to know. Please welcome CA Nilesh Shah once again. I would request CA Aftab to please come and hand over the bouquet to Mr. Nilesh Shah. You keep clapping. India, way forward, CA Nilesh Shah.
Good afternoon to all of you. And why should you bother about India? All of you are based in Bahrain. And I was talking to Alok, who said that most of you are unlikely to return to India. So why should you worry about India? I think you should worry about India because over the next couple of decades, it will emerge as one of the largest economies in the world. If the 20th century was for China, 21st century will be for India. Whether it can happen earlier or later, that the new government will decide. But eventually it will happen. And you need to worry about India because knowing India, knowing Indian language, Indian culture, Indian business will be beneficial to you, if not now, probably a few decades later on. The problem is that as of today, India has lots of problems. The good news is that for all the problems, India has solutions. Unlike many countries in the Western world where they have problems but no solutions. We have problems and we have solutions. If you see Indian growth story, for almost 80% of the time civilization is in existence, it has remained the top 2 economies in the world. It's only post-colonization that India lost its mojo, it's lost its top positions in the global markets. And now, slowly but steadily, it's becoming top 5, top 10 economy in the world in terms of growth. And today, on a purchasing power parity basis, it's the 3rd largest economy in the world. If we see when did the growth came back to India, it came in the 90s when liberalization happened. It came in 2000 when IT revolution happened. It continued in the later part of 2000s when further reforms were carried out. So effectively, whenever we have liberalized, whenever we have reformed, our growth has always been higher. What is equity market today pricing in? It has gone up by about 10% in last 3 months, and it's pricing in a pro-reform stable government. In fact, all of you can use this thumb of rule. Sensex divided by 100 is the number of seats which BJP should be expected to get. If they get 180 seats, don't be surprised if Sensex falls to 18,000. And if they get 270 seats, don't be surprised if they go to 27,000. What should be government doing? And be it BJP government, be it Congress government, what should be the government doing? For last 2 years, India has grown at 5%. Now, compared to rest of the world, which is growing at 1 and 2%, 5% looks good. But compared to what India can deliver, 5% is pathetic. So there is no option for government but to push the growth. Now, why did growth degrow? Why did growth slow down? So our first problem was that we had lower investments, lower savings, and higher allocation to physical assets. Our savings rate collapsed from about 38% to about 34%. Then it came down to 32%. You save less, your ability to invest is less. Obviously, your growth slows down. The other thing, and which is where equity market is so essential, is that in India we expect companies to grow, but we don't provide them enough equity capital. So every year Indian companies pay about 100,000 crore by way of dividend, and last year they raised around 1,500 crore by way of equity capital. So we expect Indian companies to grow, but they don't have equity being made available to them. They funded their growth by way of debt, but over a period of time, bankers stopped giving debt and the growth slowed down. More importantly, while this thing was happening, our infrastructure bottlenecks came into play, and our capital output ratio, for every 1 rupee of capital, what I'm investing, how much I'm getting out, it started deteriorating. It has moved up from about 4 times to 7 times. With this kind of deterioration in capital, obviously growth had to suffer. So now we are in a cycle where growth is slowing down. We are unable to create jobs. Income is getting suffering. Because income is low, savings are low, investments are low, and again it results into lower growth. The new government will have no option but to break this cycle. If we see in last 5 years, the Supreme Court decided to ban mining operations across Orissa, Goa and Karnataka. Straightway it made more than 100,000 trucks idle. It impacted economies of those 3 states so much that year on year there was no growth in consumption. We have created such kind of problems or issues out of nowhere to curtail our growth. We think if following steps are taken, it can help move the growth needle up. India is probably one of the few countries in the world where if you import raw material, you have to pay lower duty, but if you import raw material, you pay higher duty, and if you import finished goods, you pay lower duty. So Government of India wants to make us more competitive, and that's why it always tilts the balance of scale in favor of foreigners rather than Indians. There are about 110 items where duty structure is inverted. If you can tweak that to positive side, then certainly local manufacturing will benefit and growth will automatically come back. Such simple step, but unfortunately it's not been taken in last 5 years. The second thing which Government of India did pretty well in early 2000 was introduction of Textile Upgradation Fund. It provided concessional financing to textile factories. Now, as I mentioned earlier, availability of equity is a big issue in Indian companies, and which is why Government of India kind of provided financing at 2% interest rate. Using that 2% interest rate, the textile companies over last 10 years have grown their market share in global textile markets, ready-made garments market, and they've also provided maximum employment. Now, can another scheme like that be launched in construction sector or textile sector or some other sector which can support growth? Essentially, Indian companies does not have equity capital. They need money, and cheap financing at competitive rates can again create this growth momentum. Most of us know that our public sector companies don't work properly and efficiently. You have companies like Air India, which I don't think so many of you will be using it as a first preference of airline, but it has more than $10 billion invested into it. The output, the return is virtually pathetic. It happens because there are ministers, there are bureaucrats, there are ministries which does not allow this company to function at efficiency. The same people, when they walk out from PSU to private sector, they deliver fantastic performance. But when they're inside public sector, they are unable to deliver performance. And this is partly happening because of the bureaucracy and administrative restrictions which are placed by the ministries. If we create a holding company, whereby these ministries and bureaucrats can be removed out, and this company starts functioning more like private sector, certainly that sector will start delivering growth and will have great momentum. The other thing which we have seen is that between 1997 to 2003, 2004, India was building about 20 kilometers of road a day. Now we are building 2 kilometers of road a day. The 20 to 2 has happened because of variety of reasons. If we can just cut paste what we were doing good in 97 to 2004 period and repeat it in 2014 to 2020 period, growth will immediately start picking up. When the government intended, during the Commonwealth Games time, Delhi Metro and Delhi Airport came up in record time and at a cost which was competitive to other peers in the global market. All we need is the focus which the T3 terminal in Delhi Airport or Delhi Metro received in other projects like Delhi-Mumbai Industrial Corridor, river linking, and so on and so forth. All these things can import or can support growth significantly. Rural economy is where 70% of Indians live. They contribute just about 15% of Indian economy, but 70% of population lives there. The average cost of financing in rural economy is roughly about 30 to 35%. This is because banks are not present in rural economy as much as they should be. It is still the money lender market over there. If you can spread microfinance and the other formal parts of financing, then automatically this interest cost can come down, and you can imagine what will be the beneficial impact on rural economy. A simple thing like providing an induction cooker in every single rural household will ensure that per day more than 3 hours will be available to that household, because as of today that household is spending time in, one, collecting firewoods from the jungle, second, making the food on a chula, which is not very efficient way of making food. So you could have 3 hours available if you can just provide one induction cooker in every single rural household. We have a unique system called Agriculture Product Market Committee. World over, the government encourages farmer to reach out to the consumer directly so that the intermediaries don't make excess money. If we see the Indian construct, the scales are tilted in favor of intermediaries. The farmers don't make money, the consumers pay high price, and intermediaries take away all the malai. We need to change this to ensure that farmers are connected with the consumers, and straightway that will give benefit to the growth. The beneficial impact of Golden Quadrilateral project on the Indian economy was fantastic. Between 97 to 2004, when we could build 20 kilometers of road a day, automatically our economy started improving at 8% plus. Now, if we can replicate that magic on rural roads, then who knows, economy can grow at 10% also. The other interesting thing is about infrastructure. Clearly, there are some pockets like T3 terminal or Delhi Metro, which is fantastic. But overall, the infrastructure is really, really lacking in India. The government doesn't have enough money to build infrastructure. The private parties does not have enough risk appetite to build infrastructure. So this whole concept of public-private partnership is not working out. Foreigners are not as much interested in bringing money into India in infrastructure space because their experience has not been very encouraging. So we need to build infrastructure, but we don't have capital in government's hand, we don't have risk appetite in private sector's hand, and we don't have foreigners who are interested in investing in India's infrastructure. How do we solve this puzzle? The puzzle can be solved by a concept called reverse bot, which has not been as much popular in Western world, but it can be introduced in India. So today, government of Maharashtra has given Mumbai Metro to a private party. It doesn't have enough risk appetite to build the project because there's so much of delays in building that project. The approvals don't come on time. You can't acquire land. If you acquire land, you don't have ability to construct at a faster pace. Net, the whole experience for Mumbai Metro has been quite pathetic. Now, if government can actually give the Mumbai local train, which carries, large number of commuters every day, to the private party, one, the private party will be in a position to improve the efficiency and give better experience to the consumer. Plus, they are also inheriting something which is working and they have to just improve upon it. And then, by giving away that local train to private party, whatever capital comes, government can then set up in Mumbai Metro. So government takes the money and has the risk appetite, and private party which doesn't have risk appetite actually gets a running project. This reverse BOT concept can actually work in ensuring that infrastructure starts getting developed on a faster basis. The other interesting thing is that if you see China, it has done exceedingly well compared to India. It has done well because they have blown a lot of credit into their economy. Japan has done exceedingly well compared to India because again it has pushed a lot of credit into their economy. Compared to them, we haven't pushed as much credit into our economy. Now, obviously when you give steroids to your economy, it has long-term side effects, but in the short term, it can have a lot of beneficial impact. Globally, many economies have given steroids of credit to their economy, and that's why they are doing well. India cannot run their economy at such low level of credit. If RBI can push a little bit more extra credit into the economy, automatically growth will come back. The other interesting thing which Indians have been doing is that they are saving more money in physical assets like real estate and gold rather than in equities and debentures and bonds and mutual funds and fixed deposits. If we can shift savings from gold into financial assets, that itself will give long support to the growth momentum. Today, retail investors own just about 6% of their balance sheet into Indian equities, and this excludes real estate. Clearly, by shifting this allocation from gold into financial assets like equities, money will be available to Indian entrepreneurs to run their business, and they will create growth on their own. At the end of the day, the whole country of India attracts less number of tourists than just the Museum of Louvre. Certainly, India is far better than Louvre, and we can attract far more number of visitors than the Museum of Louvre, provided we, take appropriate actions. In Gulf, fiscal deficit doesn't matter, but for a country like India, fiscal deficit matters a lot. Our growth is slowing down because government borrows so much money from the economy that there's not enough money available for private entrepreneurs. When government borrows 100 rupee, they probably create 5 or 10 rupee worth of effect. When a private sector borrows 100 rupee, it probably creates 15 or 20 rupee worth of effect. So government, by running large deficit, creates huge pressure onto the economy. Why does government create such large deficits? Because Indians don't pay tax correctly. In a country like India, there are about 42,000 people which has declared an income of more than 1 crore in FY12. Obviously, our community is a big contributor to that. And unless until this tendency of doing or not paying appropriate tax is corrected, the fiscal deficit cannot come down. By the way, we sell about 200,000 luxury cars of Mercedes and BMWs and Audis when only 42,000 people pay or declare income above 1 crore. If our tax collection system was not benevolent enough, we have ended up giving more tax concession than the tax revenues which we are collecting. All kinds of excise, customs, IT and personal income tax exemptions today account as much as what our tax revenue is. And that's reflected in the lowest tax to GDP ratio in the whole world. Countries like Singapore, Thailand, Philippines, Malaysia, on an average, about 15% of their economy is represented by tax revenue. In India, we are just around 11%. In the developed worlds of US, France, England, about 30% of their GDP is represented by tax revenue. We are at about 11%. So you can imagine how worse we are in terms of tax compliance. The government of India does not sell its assets like minerals, spectrum correctly, though there is a change now happening. But if we can monetize our resources well, then probably we don't have to worry about fiscal deficit as much. The government of India owns large amounts of land, which it can monetize well. The government of India's investments in PSU stock is exceeding $600 billion. You can monetize that once in a while, again to raise resources and avoid deficits. And even, undertaking like SUTI has about $10 billion plus investments. So if government monetizes its assets properly, then deficit can come down. More importantly, we end up paying large amount of revenue by way of interest. About 42% of our income is paid by way of interest. And what's India's debt to GDP ratio? It's just about 60%. Japan has a debt to GDP ratio of 200%. If they were paying interest like India was paying, they'll be paying more than 2 times their income by way of interest. This is the dichotomy. We are paying so much of interest out of our income that there's nothing left for investment. There are many countries whose debt is far, far higher than India, but because their interest rates are low, they are able to pay much lower amount in interest and spend balance amount in infrastructure investment. The other thing is related to subsidy. The political system today patronizes vote bank politics by way of subsidy. We end up spending about 250,000 crore every year by way of subsidy. And it's not reaching out to the actual users, it's getting usurped between the intermediaries. If we can manage subsidy well, then hopefully there will be more money available with the government, and then the deficit can come down. The other thing is related to current account deficit and rupee. We have seen rupee depreciating from 44 to 68 in a short period of time, and then pulling back to 60. Why did that sharp depreciation in rupee occur? It occurred because as a country, India was importing too many things which it couldn't afford. So we ended up importing $10 billion worth of mobile phones. we are the world's largest importer of mobile phones. We have the third largest reserve of coal, and still last year we ended up importing $16 billion of coal because mining was banned for coal. If you see items like fruits, nuts, and vegetables, we have imported almost $5 billion worth of fruits. This extraordinary spending on imports of unnecessary items resulted into rupee to depreciate, and hopefully with this rupee depreciation will mend our ways, and current account deficit and rupee both will come under control. The other constant thing which we talk about is the imminent rating downgrade which can happen to India. Today, all the three rating agencies are waiting for next budget and next government before they can decide what to do with India's rating. I think we need to engage with rating agencies better. If you read this chart, it shows that higher the debt, higher the rating. But that's not true. We have 5,000 years of recorded history in which India has never defaulted to foreigner. Whereas there are countries like Greece which in last 400 years have defaulted about 22 times to foreigners, and yet they enjoy higher rating than India. So government of India needs to engage with rating agencies better and show that 5,000 years track record to ensure that at least we don't get downgraded to junk level. Inflation, I'm sure all of you would have heard from your relatives that inflation is a big problem in India. And these are few of the items in which inflation has been conquered in India. The motor car over last 14 years have remained inflation free. Most of the electronic items have remained inflation free over last 10, 15, 20 years. Some of the services like telecom has also remained inflation free over last 15, 20 years. And while the real estate prices have gone up, the rental yields have remained inflation free for last about 10 years. So in certain parts of economy, we know how to manage inflation. We just need to do cut paste for the balance of the economy. The other interesting thing which we have heard about is that we need foreign direct investment and foreign institutional investors flows to come into the country. On an average, we receive about $25 to $30 billion of FII flows a year, and we receive about $30 odd billion worth of FDI. And against that $60 billion which comes into country every year, and for which the Prime Minister, the Finance Minister, the Commerce Minister keeps on circulating around the world, India exports about $60 billion by way of import of gold. So on one side, we go with a begging ball to the various parts of the world, asking them to invest in India. And on the other side, we import $60 billion worth of gold by sending those money abroad. So this is the tweak in the FDI and FII flows. Notwithstanding that, the experience of companies which have invested in India has been fantastic. If you see the performance of Maruti Suzuki versus Suzuki Motors Limited, in the 80s when Suzuki came to India, India was nowhere on their radar. Today, Maruti contributes 1/3 of their turnover and 1/2 of their profitability. And obviously, Suzuki Motors' performance in Japan on stock market moves depending upon how Maruti stock prices move. And despite that, since listing of Maruti Suzuki over last 10 years, Maruti has outperformed Suzuki significantly. Investors have made 10 times more money investing in Maruti compared to investing in Suzuki. And this case gets repeated in Siemens, in Alstom, in Hindustan Unilever, in Procter & Gamble. You name the company, their Indian subsidiaries have outperformed their foreign parents by multiple of times. Obviously, we need to present this to the investors so that instead of buying Suzuki in Japan, investors actually come and buy Maruti in India. That's how we will get foreign direct investment and foreign portfolio investment. These are some of the bluest of blue chip Indian companies where FIIs have put in large sums of money. The total investment of FII in HDFC is about $18 billion. In Infosys is about $10 billion. In ICICI Bank it is about $10 billion. Clearly we need to give next Infosys, next HDFC, next ICICI to foreigners so that they can invest into these companies. The other interesting thing, without including gold, is that a lot of Indians have gone and invested abroad. So while we received $30 billion in 2010, we also exported about $14 billion overseas by buying companies like JLR or Chorus or other companies. So clearly we also need to ensure that the Indians remain invested in India rather than going abroad. The real issue for India remains governance and rule of law. The next government has to tackle these two issues, and then I have no doubt in my mind that India will be on growth path. And like China today is more important for the global economy, probably a few years down the line, India will become as important for global economy as China is today. Thanks. And if you have any questions, I'll be happy to take.
Sir, it was very nice and very interesting to know how India we can look forward. You are talking about the induction stove to be given. Where is the power? 10 hours, no power. In the place where I am staying, my mother is staying. How the power is going to be resolved? The Congress-ruled states are different, non-Congress states are different, and there is always fighting between the governments. What is this happening? How can we think of a place where 10 hours, no power? How can we go and stay? Please tell me, sir. Thank you.
So there is 20,000 megawatt of power plants which today are not operational. They are not operational because we can't provide them gas. Now, gas is there in the ground, but it's not coming out because you are not incentivizing manufacturing or production of gas. You put that 20,000 megawatt of gas power plants into operation, most parts of India will start receiving the power which they require. Maybe about 15-20 years ago in Gujarat also power was not available equally. Today they have taken steps and now power is available 24/7 in Gujarat. So what we did in Gujarat, we need to do it in Tamil Nadu, we need to do it in Andhra Pradesh. Kolkata, about 3 decades back, was perennially short of power. Even in a state like today, Kolkata has 24/7 power. So it's the political will. You need to take right steps. I don't think so. Availability of power could be an issue in a country like India, which is endowed with wind, which is endowed with solar, which has hydropower capacity, and which has third largest reserve of coal in the world. A state like, and I'm not sure which state it is, but one of the northeastern states, most probably Mizoram or Arunachal Pradesh, one of those two, has ability to produce 80,000 megawatt of hydropower. Now you require vision to build a 3 gorges dam which can produce 16,000 megawatt of hydropower. You have to have the vision, and that's where the government has to work. If we have voted smartly, then yes. On the gold side, you have to worry when Indians decide to sell gold. I don't know how many of you are aware about this story or not, but in the early 70s, there was a family called Hunt brothers in US. They were third or fourth richest family in the US, and they wanted to become the richest family in the world. And using their research, they found out that if they can corner silver, it was getting used in industrial usage on an increasing basis. So if they can corner silver, they could make lots of money. So the Hunt brothers started buying silver, and they tracked every single mine in the world. They had tracked every single production in the world. And slowly but steadily, silver prices started going up. And they were buying more and more silver, pledging that bought silver with banks and financiers and getting more money to buy more silver. Silver prices shot up probably about 10 to 12 times during that period. But eventually, Hunt brothers thought that at some point of time, they would have cornered enough silver, and without buying, the prices will continue to skyrocket. But silver supply kept on emerging, and silver supply kept on coming from Gulf state, including Dubai, where there was no silver production. They kept on buying silver, silver supply kept on coming, and eventually they were in no position to buy because no one was willing to give them money. Finally, the lenders started liquidating silver, and silver prices came exactly where it all began with. In the process, the third or fourth richest family of US at that point of time, Hunt brothers, became bankrupt. Now, why did that whole thing happen? Where did the Gulf countries got silver? That silver actually came from India. Indians knew what was the value of silver. They started melting their silver utensils, idols, and everything, sent silver to Middle Eastern states, and in turn brought gold. And that supply bankrupted Hunt brothers. So on gold, please talk to your relatives in India. The day they stop buying gold, that's the time to go and short gold. We are the largest consumer of gold. We are the largest holder of gold. And I do see that at least the new generation of India is not wearing gold as much as, the old generation probably was. The banking system is now reaching out to every nook and corner of the country. And a lot of people who bought gold for a variety of reasons probably will start using bank deposits and equities. So my guess is that over a longer period of time, gold will continue to underperform other asset classes like Indian equities or Indian interest rates. And the day Indians decide to sell gold, go and short gold. That will be the best trade of your life. On the rupee side, we think the destiny of rupee is to depreciate. It should ideally depreciate between 4 to 6% every year. And it should depreciate because our inflation levels are high, our productivity levels are low compared to the Western world. But unfortunately, rupee in the short term is driven more by capital flows rather than, this 4-6% depreciation. So you will always have a scenario where rupee will either be undervalued or overvalued. And then a sharp correction will occur. That journey of 44 to 60 now has probably ensured that for next 2 to 3 years, we won't see a sharp correction. But at some point of time, I'm sure after, say, probably 2 to 3 years, we'll cover up that 4-6% every year in just 1 year. So for next 2 to 3 years, the rupee is likely to remain stable with marginal depreciation. And then, unless until we have taken steps like this, another bigger depreciation. But overall, you can price in about 4 to 6% depreciation in rupee every year.
Thank you very much. I would request CS Sushil Jain to please come and hand over the BCIC memento to C. Nilesh Shah. When I was young, there were two songs very famous, Killing Me Softly and Smooth Criminal. Today I know somebody came and gave a killer speech in a very soft and smooth manner.